Welcome to Module 16. In Module 16 of Accounting 5000, we're going to look at owner's equity. In this module, we're going to take the first part of Chapter 8 and look at common stock, preferred stock, paid-in capital, and a little bit about dividends. We'll then complete the rest of the chapter in Module 17. So let's talk a little bit about what owner's equity is. Owner's equity is the owner's claim to the assets of the company after all the liabilities have been paid. So if you think back to your accounting equation that assets equals liabilities plus owner's equity, moving the liability side to the other side of the equation, you get assets minus liabilities equals owner's equity. So that's what it consists of. By definition, this is the claims that the owners have to any assets after they pay their liabilities to the creditors. This is a term that we use, owner's equity, for corporations. Partnerships and sole proprietorships have a little bit different terminology. In sole proprietorships, we just have one capital account, which we call the owner's investment account. And in the partnerships, we have several capital accounts for each of the owners who have a capital investment in the firm. So what we're looking at here is strictly for corporations. Let's talk about what paid-in capital is. Remember that our owner's equity section consisted of two parts, paid-in capital and retained earnings. The paid-in capital amount consists of the two types of stock and what we call additional paid-in capital. There are two types of stock, common stock and preferred stock. Common stock are the owners of the company. They're the actual residual owners, as we call them. Preferred stock is a special kind of stock in which the owners of that stock don't actually have any say in the running of the company, but they do have a preference as to dividends. In other words, they receive their dividends before the common shareholders do. The third component there is additional paid-in capital. This is the amount that is paid for stock over and above the par or stated value of the stock. Most stock has a par or stated value. Par value stock of $1 means that the stock will be entered on the books at $1 a share. No par stock, and there are a few corporations that issue no par stock, it puts all the money they receive from the sale of the stock into the common stock account. In that case, if you have no par stock, you do not have any additional paid-in capital. Because additional paid-in capital is everything that's paid for a stock over and above the par value or stated value. So if you have par or stated value, you have additional paid-in capital. If the stockholders paid more for the stock than the stated value. If you have no par stock, you do not have additional paid-in capital. Let's talk a little bit about common stock and what it entails. Common stock are the actual owners of the firm. This is the type of stock you can buy on the exchanges. You own a piece of the firm. If you go out and buy stock, and typically stock is sold in lots of 100 shares, you own 100 shares of that firm. But realize that there may be millions and millions of shares of stock in that firm. So your actual percentage ownership may be very, very small. And you may not be able to influence how that company is run. But the group of shareholders of common stock do run the company. As a whole, they run the company. They will have annual meetings once a year in which they will determine things like the goals of the company, and they will listen to what management has to say about the running of the company that year, and they make a lot of decisions as to what goes on in that firm through the election of directors. We call them the board of directors of a company. They are typically elected by the common shareholders, so they have a way of running the firm through their ownership of the stock. Remember, these common shareholders have a claim to all the assets after the debts are paid. The nice thing about being a common shareholder is that you cannot lose more than the money you paid for the stock. If a company goes bankrupt, you will not have to pay the debts of that firm if the firm owes more than it has assets to pay with. So your actual amount of investment is limited to what you paid for the stock. There's some terms you need to know about common stock. Let's talk about a few of those terms. Common stock is authorized to be issued by the Secretary of State of the state in which the company is doing business. So if a company is chartered in the state of Tennessee, the Secretary of State of the state of Tennessee allows that company to issue a certain number of shares of stock. Those are called authorized shares of stock. The company may then start to sell stock, and the number of shares that it actually sells are called issued shares of stock. Issued shares of stock will be less than or equal to authorized shares. They cannot sell more than they're actually authorized to issue. Now, the outstanding shares of stock are the shares of stock that were authorized and were sold, in other words, issued, and are still outstanding and are still out there. Now, there are some instances in which stock that has been authorized and issued has been bought back by the firm. We call that treasury stock. When a firm goes out and buys its own shares of stock on the market, then that's called treasury stock. The stock is put in the treasury of the firm. So the difference between authorized and issued will be that the company has not sold all the shares of stock they were authorized. The difference between issued and outstanding will mean that some of the shares of stock they sold have been bought back. And that is called treasury stock, the ones they bought back. Another term you might want to be familiar with is preemptive right. Anytime a shareholder owns stock in a company, they have a certain percentage ownership of that firm. They are allowed to maintain that percentage ownership if there is a new set of stock that's issued. So if a company gets authorization from the Secretary of State to issue more shares of stock, each stockholder has the right to maintain his or her percentage ownership by buying more shares of stock. They don't have to, but they are given that right to maintain their percentage share of ownership. That's called their preemptive right. Let's talk a little bit about preferred stock. Preferred stock is different from common stock. These are not the basic owners of the firm. They are sort of a quasi-debt issue in that individuals who buy preferred stock are going to get a return on their stock, and that return is stated in the way the stock is described. They are preferred because they have a preference as to dividends. Remember, they get their dividends before common shareholders do. And usually the preferred stock is listed as 10% preferred stock or $2 preferred stock. If it's 10% preferred stock, they get 10% of the purchase price or stated price of the stock as a dividend. If it's a $2 preferred stock, that's the amount of dividend they receive, is $2. So you're told in the title of the preferred stock what the dividend will be. Remember that dividends are paid out of retained earnings. So a company must have both the cash and the retained earnings in order to pay a dividend to either preferred shareholders or common shareholders. Additional paid-in capital, we said earlier, was the amount of capital that an individual contributed to the firm over and above the price of the stock he or she bought. So if you have a $10 par value stock that's sold for $12, you have $10 that goes in the common stock account, and you have $2 that goes in the additional paid-in capital account. You can have additional paid-in capital accounts for both common stock and preferred stock if you sell the stock for more than the stated or par value. Now, preferred stock is an interesting stock to buy because there are a number of characteristics attached to preferred stock that make it very enticing to investors. For example, cumulative preferred stock means that if the company misses a dividend payment, that dividend payment must be made up in the future before any stock dividends can be paid or cash dividends can be paid to common shareholders. So if you're buying preferred stock, you would like for it to have the cumulative feature because that means you're going to eventually reap all the dividends that it says on the stock that you will receive. Participating dividends, if it's a cumulative participating stock, not only do the stockholders receive the actual stated amount of the dividend, but if extra dividends are given over and above that percentage or that stated amount, they get to participate in the excess. They participate with the common shareholders. So additional dividends that are given out will be divided up between the preferred shareholders and the common shareholders. So if you're buying preferred stock, you want it to be cumulative and you'd like for it to be participating. Most preferred stock has what we call a liquidating value, which means if you want to turn it in, it has a value that you will receive when you mail it back in or turn it back in to get some money. It also has a redemptive value where the company will come and pay you a certain amount for that stock, usually a little premium over and above what you paid for it. Callable preferred stock means that the company can ask for that preferred stock back at any time. Lots of companies will do that. Again, they will have to pay a premium. And finally, convertible preferred stock means that the preferred stock can be exchanged for a certain number of shares of common stock. And this is usually stated in the agreement that's convertible to X number of shares of common stock. Again, this is a very attractive feature for investors because as the common stock value rises, they will have a better investment with their preferred stock. And if it gets to a point where they are better off switching from preferred to common, they may do so. So it's a very attractive feature. But the two to be most familiar with are cumulative and participating. These are the two characteristics that make a preferred stock have extra value. Additional paid-in capital, then, is the third component over and above common stock and preferred stock. This is the amount of money you've paid in over and above the par value of the stock. You don't have any of it if there's no par stock. Occasionally, you will see it be used when some strange events happen, and these typically are things involving treasury stock or certain gains and losses. We will use up that additional paid-in capital. But they're very unusual events, and we're not going to deal with them in detail in this course, as we're just doing an overview of what stock is like. So you have preferred stock, you have common stock, you have additional paid-in capital, which can be either for common and or preferred stock. You also have retained earnings. Now, retained earnings are exactly what they sound like. This is the net income that has been kept in the firm, retained in the firm. You have not so far distributed it as dividends, but it is available to be distributed as dividends. A key thing to remember is that although it's retained earnings, it is not cash that's sitting around somewhere. Retained earnings have probably been invested in additional equipment, more inventory, perhaps some accounts receivable. It's typically been invested in other assets, so it's not sitting around a little pile of cash somewhere. These are just earnings that have been kept in the business. There are only three things that can affect retained earnings. It will go up if you have net income, it will go down if you have a net loss, and it will go down when you pay dividends. So those three things are the only things that can affect retained earnings. And if you remember our little equation that our owner's equity consists of paid-in capital, which would be common stock, preferred stock, and paid-in capital, and retained earnings. Retained earnings is affected by only income, losses, and dividends. Well, what about these dividends? How do we pay out dividends? Well, we're going to talk today first about cash dividends, and then in the next module we'll talk about other types of dividends. But cash dividends are the ones that you're most familiar with. Cash dividends are a check that are sent out to shareholders, common and preferred alike, as a return on their investment in the stock. In order to pay a cash dividend, a firm has to have two things. It has to have cash, because they're going to be writing checks, and it has to have retained earnings, because they're going to be taking them out of retained earnings. These cash dividends are voted on and approved by the board of directors. So they don't just happen, they have to come about through the board of directors. Remember we said earlier cash dividends are not an expense. They do not show up on your income statement. They are simply a reduction in retained earnings. So they will show up on the statement of changes in owner's equity, but not on the income statement. Well, some things you need to be familiar with about dividends. There are three dates that are very important when you're dealing with dividends. The first one is the date of declaration. Now, remember we said the board of directors has to vote on when these dividends are going to occur. The day the board votes on a dividend, that's called the date of declaration. At that point, it becomes a liability to the firm. The firm will have to pay those dividends. Then you have the date of record. The date of record is when the people who own the stock as of that particular day will actually receive the dividend. So people who buy the stock right before the date of record will receive a dividend. Those who buy it right after the date of record will not. So you have the date of declaration when it becomes a liability. You debit retained earnings and credit dividends payable. You have the date of record. You don't make any journal entry at that point. You just keep track of who owns stock at that point, so you'll know who to pay the dividends. Then finally you have the actual date of payment. That's when the company writes the checks and sends them out to the shareholders. At that point, you debit dividends payable and credit cash. So there are only two times when you make journal entries. When you declare the dividends and it becomes a liability, when you actually pay them to the people as of the date of record. In that case, you eliminate your liability and you pay out your cash. So those are the only two times you need to be making journal entries into your accounting records related to dividends. So let's work a few problems that deal with common stock and dividends and paid-in capital. And let's start with exercise 6, which is in your textbook on page 297 at the very bottom of the page. This has to deal with common stock. They show you a balance sheet caption for common stock there in that purple bar. Common stock without par value, which means it's no par common stock. 4 million shares were authorized. The Secretary of State allowed them to issue 4,000 shares of stock, but they've only issued 800,000 of them, so they've only actually sold 800,000 shares of stock. And there are only 720,000 of them that are still outstanding. The total value for that stock is $2,600,000. They ask you in Part A to calculate the average price at which the shares were issued. Well, if you issued 800,000 shares for $2,600,000, you simply divide to come up with an average issue price of $3.25. In Part B, it says if these shares were assigned a stated value of $1, show how the caption would have been different. Well, if you have a par or stated value, you have a common stock entry, which is that first couple of words under letter B. You put in there the stated value is $1, how many shares were authorized, how many shares were issued, and how many shares were outstanding. And you multiply the dollar stated value times the number of shares that were issued, which is $800,000, and everything over and above that $800,000 is additional paid-in capital. So we know that we issued them for $2,600,000. $800,000 is going in our common stock account. $1,800,000 is going into our additional paid-in capital account. So you still have the $2,600,000 that you had with no par stock. It's just divided up into two sections. In Part C, it says if a cash dividend of 18 cents per share were declared, calculate the total amount of cash that would be paid to shareholders. You're only going to pay out cash to those individuals who actually have the stock in their hand. That is the outstanding number of shares of stock. Not the authorized, not the issued, the outstanding number of shares of stock. In this case, that's 720,000 shares. You're paying each share 18 cents. So you're going to pay out a total of $129,600. In Part D, it says what accounts for the difference between the issued shares and the outstanding shares. Now remember, if we issued them, we've sold them. If they're outstanding, they're still out there. So there's a difference between what we actually sold, in this case, and what's still out there. And that's because we've gone and bought back some of those shares of stock. The stock we bought back would be treasury stock. And in this case, that would be, how many shares of stock? That would be 80,000 shares of stock that we've bought back. The difference between the 800,000 that was sold and the 720 that's still out there would be 80,000 shares of treasury stock. So that is an example, good example of how we deal with common stock. Now let's look over at preferred stock and use exercise 8 as an example of how we deal with preferred stock. In exercise 8, it tells us to calculate the dividend amounts of preferred stock under each of these following scenarios. In letter A, we have a semi-annual dividend on 9% cumulative preferred $60 par value, 10,000 shares authorized, issued, and outstanding. In this case, they've been authorized 10,000 shares, they've issued 10,000 shares, and all of them are still out there. So we're going to pay dividends to 10,000 shares of stock. Notice that the par value is $60. Typically, par value is 100, but in this example, it's 60. And we're paying 9% dividend. So each share of stock is going to get 9% of $60. 9% of $60 is what? It's about $2.70. And we've got 10,000 shares of stock. So we take our 9% times 60 times 10,000, and we take half of it, $27,000 total. We take half because these are semi-annual dividends, which means we pay $9,000 out over a whole year, so we only pay 4.5% each of the 6 months. Now letter B, we're paying an annual dividend of $2.40, cumulative preferred stock, 100,000 shares authorized, 60,000 shares issued, 53,200 shares outstanding. Last year's dividend has not been paid. Well, the first thing we have to do is figure out what our dividend would be. Well, the $2.40 tells us that that's the annual dividend amount, $2.40. Now we have to multiply that by the number of shares that are outstanding, which is 53,200. So we take $2.40 times 53.2. That meant that each year we should be paying a dividend of $127,680. But they didn't pay it last year. Now remember, this is cumulative preferred stock. So if we don't pay it one year, we have to pay it next year plus the one we would owe anyway. So we owe 2 years worth of dividends. So we take 2 times the $127,680, and we end up with $255,360. In letter C, it says a quarterly dividend on 13.2% cumulative preferred, $100 stated value, $103 liquidating value, 60,000 shares authorized, 52,000 shares issued and outstanding, and there are no dividends in arrear. So even though this is cumulative preferred stock, we don't owe any from past years. We've been keeping up with that. So we only have to pay this year. However, notice that it's a quarterly dividend. So we're going to take the total dividend and divide it by 4. So since it's 13.2%, we take 0.132, multiply that by the face value of the preferred stock was $100. There are 52,000 outstanding shares of stock. So we multiply that together. That's what we would pay each year. Since we're paying it 4 times a year, we only pay 1/4 of it each time. So we divide that by 4, and we end up with $171,600. Let's continue our discussion of preferred stock by looking at exercise 10, which is a little further down page 298 in your textbook. We have a company that did not pay dividends in 2002 or 2003, even though 45,000 shares of its 8.5% $70 par value cumulative preferred stock are outstanding during these years. The company had 263,000 shares of 250 par value common stock. So in Part A, they want you to calculate the annual dividend for each share of preferred stock. So we have preferred stock that's 8.5%, $70 par value. We take 8.5% times $70. Each share of stock would receive $5.95 in dividend. In Part B, it asks us to calculate the amount that would be received by an investor who owns 200 shares of preferred stock and 450 shares of common stock, and he's done so since 2001, and there's a 25-cent per share dividend on the common stock that they're going to pay in 2004. Let's figure the preferred stock first. You're going to receive $5.95 per share on preferred stock dividend. The individual owns 200 shares, so you would multiply 200 times 595. He hasn't been paid for 2 of the past years, nor for this year, so that means he will be paid for 3 years. The 2 years that he was not paid plus this year, so that's 3 years, so he would get a total of $3,570 for his preferred stock. Common stock is not cumulative, so he would only receive the dividend for this year, which is 25 cents a share times 450 shares of stock, which would be $112.50. The total that would be received by this individual is the $350.70 plus the $112.50, so a total would be $3,682.50 that this individual would receive this year on both the preferred and the common stock. So what we've seen in this module is an overview of common stock, preferred stock, retained earnings, and we've done a couple of problems dealing with stock. We'll continue this chapter in the next module.